Well, it's my pleasure to host this panel. As you can see, we have various industry veterans on this panel, all of them coming from very different backgrounds, but nevertheless, they've been in the market for many years. And I'm very excited to cover this very interesting topic. So before I start, I briefly introduce myself, then I will pass on to my panelists to introduce themselves as well. Currently, I'm heading Manulife's investment management, the private markets business for Asia. And as some of you may know, Manulife is one of the largest Canadian insurance business and also a top 3 North American insurance company in terms of AUM, and as well as one of the top 3 insurance company in Asia. And in particular in China, actually, we have a joint venture with Sinochem, and we have an on-the-ground life insurance practice in China as well. In terms of private markets, actually, we are building the third-party private markets business in Asia, which covers broadly from private equity to real estate to infrastructure, as well as private credit. So it's a big mandate, and I'm quite excited within Manulife to build a business at current time. So with that said, what I'm going to pass on to my panelists. Maybe I start on my screen with Jay. Jay, go ahead.
Thank you, Myron. Good to be here. My name is Jay Gong. I'm a partner of Pantheon Ventures. Pantheon is a global private market fund of funds with $58 billion of assets under management. We've been a very active investor in private equity, and in particular in Asian private equity and venture capital. China is a very big piece of the Asian private equity venture capital investment program. And we pride ourselves of being a very long-standing investor in the market. So great to be here to share our insights.
Thank you very much, Jay. Joseph, you want to be the next?
Thank you, Myron. So I am responsible for ADB, the Asian Development Bank's equity investment arm. ADB tends to be well known for its sovereign lending and its debt investments, but we also have a significant equity investment portfolio. So we have about $1.8 billion worth of equity investments spread across Asia. Our equity investments are designed to create both a sort of positive economic impact, but also a very positive development impact, and that's at our core. Our equity investments are for development capital into businesses looking to grow and expand. We want to back sort of ambitious management teams, and we typically invest between $10 million and $100 million and take a minority equity shareholding. Once we've made equity investments, we can then support businesses with technical assistance facilities and debt of up to about $500 million. So we're looking to really sort of promote a positive development agenda across Asia. Thank you.
Thank you, Joseph. Then the next one, I would like to also introduce Wanlin. Wanlin, go please.
Thank you, Myron. Hi, everyone. My name is Wanlin Liu. I am a partner with Carlyle Asia Partners. Carlyle is a global alternative asset management firm and one of the earliest global firms to have established a presence in Asia, and particularly in China, where we have been investing for the past 2 decades. Our main products are a buyout our flagship buyout fund, as well as our growth fund, which focuses on earlier stage growth capital equity investments. We are quite diversified across different industries and looking to work with entrepreneurs in financial services, technology, consumer, healthcare, and industry sectors. Thank you.
Thank you, Wanlin. And also the last will be Crystal. Actually, she has a very different and interesting background as well. Crystal, please.
Thanks, Myron. Hi, everyone. I'm Crystal. I'm a partner of GurryShark Capital. GurryShark, as you may know, is short for Greenland shark. It is the longest living vertebrates on the earth, which can live up to 500 years, but grows very slowly, only a few inches per year. And that speaks to our investment philosophy, which is evergreen capital, truly long-term and compounding focused. Our background is that we are a family office of internet founders in China. And what we do is essentially two things. One is backing emerging next generation talent, especially in the venture capital world globally. And two is backing technology entrepreneurs transforming the world with a consistent vision. Thanks, Myron.
Thank you, Crystal. So as you can see, we have a well-versed panelist, and today's topic is also quite interesting. It's finding a high growth company in a low growth environment. So I have a broader question to start with. Are we really expecting real slowdown in growth from the high performing, high growth sectors in the last decade? If so, what's the general expectation for the coming few years, which including what are the headwinds, as well as the ongoing growth drivers that we are facing? So maybe I will ask Jay to start, because as a global fund manager, you guys look at more broadly across different segments. So an overall view from your perspective would be very helpful. Jay, please.
Thank you, Myron. Broadly speaking, the investment thesis that the Chinese private equity and venture capital industry focuses on can be condensed to consumer, digital, technology, and healthcare. Those have produced very strong returns in the past, and behind them are multi-decade trends, I would call mega trends, that are quite enduring, that are supporting the fundamentals of those industries' continuous outperformance or potential for outperformance. There are certainly areas to watch out for that can be, headwinds to the sectors, for example, regulatory changes, for example, valuation. But beside those points that could actually create volatility and fluctuation, the overall trend or the long-term trend is that those industries will continue to receive many dividends that are brought on from the desire of higher productivity and better efficiency. So those underpinning factors do not go away. So I continue to be constructive on all those areas. But in particular, the key in doing this in China is really to stand with winners.
Thank you very much, Jay. So with that said, maybe the next one I would like to turn Crystal, because you guys are at the forefront of emerging manager as well as the new economy technology. So what's your thoughts on this?
Yeah, and we always believe in technology transforming the world, and for us that keeps us permanently excited about the changes that we're going to see. I can talk about two drivers that we are particularly interested in and excited about today. One is structural, and second one is regional. The structural driver is that at the top level, we believe that technology is driving a decentralization of economy, all levels of participants, as well as empowering of individuals, such as the creator economy you are seeing in the US is just a reflection of that. So the themes, investment themes that are making us truly excited today is the potential of Web3, together with blockchain as the fundamental technology that enables value exchange, value verification, through the form of metaverse, which we are seeing getting to a tipping point in the next couple of years, with the hardware equipment reaching 10 million pieces soon. So it's something as big as internet, somewhat different. Hard to say whether the technology behemoths today will retain their power in some form, but we see very interesting investment opportunities in this sector for venture capital. In the US, there are some already billion-dollar companies doing amazing things in these in this sector or in this broad scene. And in China, we are starting to see some earlier stage, maybe a Series A round or Series B round deals in this particular sector. Early stage, but enough to watch out for. So that's the structural thing. The regional thing, which I think is already on many people's radar screen, is the software, SaaS opportunity in China. By very rough numbers, China has about a dozen SaaS companies, or not even SaaS, software companies, valued at over $5 billion of market cap. In the US, number is over 100. And the gap is closing over the next decade. And we are seeing many solid companies reaching $50 million of ARR already, and they're ramping up so quickly. And SaaS, enabled by big data and AI technology, is even more powerful. And it's truly transforming how the traditional industries, companies operate. So that's an obvious opportunity set, but also a very big one. And it's something that managers are targeting systematically today, we're seeing.
Thank you, Crystal. I think I can agree with you more, especially with COVID, which has accelerated the digitalization of everything we touch on these days. And so with that said, I'm also very interested to hear from Joseph, because from a traditional segment such as ADB, how well are the potential new growth or the new technology being adopted in the traditional segments?
Thank you, Myron. So I think one of the exciting things is that if I look back 20 years ago, some very traditional sectors that were seen at that time as being quite boring and unexciting with little innovation have now surprised us all. You know, there's been power generation was traditionally never an area where one would see it as being innovative. But actually in recent years, very recent years, there's been a lot of innovation. Some really exciting companies have set up, looking at the sort of challenges of climate change in a completely different way. And hence, I think the key message I'd say is that we don't know what's going to sort of come out and surprise us in the next few years. And many traditional industries that perhaps seem boring and unattractive to investors at the moment, there will be opportunities in some of those sectors for innovation and clever, talented businessmen who are ambitious to reframe the model, to look at more interesting ways of doing things, more cost-effective solutions. So I think that's extremely exciting. I think there is, I mean, just building on some of the comments from the other panel members, there are clearly some consistent themes. So climate change, sadly, is not going to go away. I think that will continue to be a key driver of innovation for the next few years. I think clearly healthcare, because of the terrible COVID crisis, healthcare will clearly be a massive area of focus all around the world going forward. And I suppose the final comment from me would be, it's not clear, I think, how the world has really changed as a result of COVID. I think things will be done differently, but the long-term effect of COVID on how we work, how we live, how we go out, it's very difficult to predict what that long-term effect would be, but that very change will create new investment opportunities for innovative businesses able to predict how consumers will behave differently, and will create new exciting ways to provide products and services to meet that changing world that we will be living in once hopefully this terrible pandemic is over. Thank you.
Yeah, Joseph, I can't agree with you anymore. Actually, we also a firm believer in the adoption of the traditional sector, but with the new technology. As a matter of fact, actually, we are very excited. Recently, we just formed a partnership with a team focusing on China renewables infrastructure build out. And there's a big semantic view behind it. It's about energy transition from the traditional power segments to really the renewables and with the battery technologies coming online. So that's a phenomenon opportunity that we have identified and we are very excited about as well. So with that said, maybe I want to also move to the second question I have. It's more about whether there's any investment strategy adjustment or changes given the current environment. And with that, I would like to get Wanlin to lead the conversation for this one, especially given Carlyle's broad coverage in the buyout as well as the growth space in China.
Yes, thank you, Myron. Indeed, I think Carlyle's platform in Asia includes both our buyout fund as well as growth fund. And even though our flagship fund is called a buyout fund, we have been participating in growth minority investments ever since we entered the industry. And I think we've witnessed a lot of growth definitely in the Chinese economy in the past. In spite of the recent slowdown, it is still growing faster than many developed economies. I think China will continue to be a big engine of growth for the global economy, especially now in the pandemic period, as we have seen, as China has gotten this under control relatively quickly and now benefiting from the global rebound. I think a lot of the global PE firms are starting to focusing on the growth sectors, Carlyle being one of them. Historically, and what have worked for us, and what we think will continue to work, I can share with you a couple of I would say themes or strategies that we feel are that also fit with our global platform, as you have mentioned. I think one is we continue to believe in the secular tailwinds in China, especially in the consumer sector. I think everybody can see that this new generation of consumers have their own consumption behavior, which is very different from what consumers like 10 or even 5 or even only 3 years ago. So that is generating a lot of opportunities, I would say, particularly in the consumer space. So I think that's driven by demographics. That's a secular tailwind. And a second theme that we find very attractive is a geographical expansion. Given Carlyle's global platform, we have really made this to work through collaboration with our partners in the US and Europe. So for example, we have bought consumer brands in Europe, such as Montclair and the Golden Goose, and really expand their businesses in Asia and particularly in China to help the global brands. And also on the industrial side, I think more recently we also bought a renewables business in Europe, but really these large businesses are increasingly very global, so you cannot go buy a global manufacturing company without a large presence in China. And with China's a goal of a carbon zero by 2060, I think that makes China not only a manufacturing base but also a very attractive end market. So I think that our combined knowledge of the company's headquarters, which is in Germany, as well as their local manufacturing and understanding of the growth potential in China enables us to play into that theme. And then last but not least, which has already been said by Christo and Jie in particular, are the tech-enabled disruptors. There are continuing to be new technologies. We are not quite at the forefront as Christo's fund, but I think we are I would say quite progressive among the global PE firms, and have made a lot of investments in the technology sector in China.
Thank you, Wanlin. Maybe I'd also like to ask Jay to comment on this, especially given you guys are one of the global fund. So in a sense, you are on relatively top of the food chain. So you can see your portfolio as well as your underlying fund managers. whether there's any shift or change in their investment style given the current focus.
Yes, I think we're the selector of managers, and for us, the ground has become far more fertile with opportunities. What I mean is the deepening of the pool of talent, both by experience and also by their specialties. For a very long time, we've been looking for managers that display that domain knowledge, that can have a differentiated angle in attracting entrepreneurs or in providing value add. Easy said than done for a long time in China. But I think recently the moment has arrived where we see very, very clear specialization in very distinct areas. Even within technology, these days there are funds out there focusing on healthcare technology alone, or on enterprise software alone, or alternatively on tech-enabled supply chain solutions. So it's that finely defined, and it's really a great, rich picking ground for people like us. It also puts more onus on the selection itself. There are a lot of very interesting value propositions being made by those GPs to their entrepreneurs. We also need to be extra discerning on whether they're raising the right amount of capital to their relative to their resources and relative to their runway, and whether alignment of interest is there, whether that sector is broad enough to survive any regulatory change or any unexpected turns of the industry iteration or evolvement. So a lot of things to think about, but certainly, very good times for manager selection. One thing I would say is I've never seen the market being bifurcated like this in my time as an LP for the last 14 years. I think that the haves and have-nots have never become so distinct when it comes to fundraising time, accessibility, the level of oversubscription, and so forth. So considering alignment of interest, the top note when it comes to making sure that you're supporting the GPs that are still having the same investment motivation and thesis as when you backed them 5 years ago. So that's another thing I would highlight. I think when it comes to the broad market trend, I have certainly seen a lot of doubling down on the winners, a lot of the supra prorata allocation to the, I would say, the pole positions in a given sector. So a lot of people are putting money with the winners or the emerged leader and so forth. And I have seen, as a response to that, valuation picking up quite a bit in those very late round, leading to the IPO, and correspondingly, a number of the growth capital managers moving a little bit earlier to be able to get more favorable valuation, relatively more favorable valuation. So there are ebbs and flows in this. We have seen this movie played out a few times historically, but right now it feels like public market is very buoyant, and as a result, the crossover round is very popular. Valuation with the corresponding high valuation. So valuation is always something to watch out for.
Thank you very much, Jay. Actually, you touch a very good point. Everything comes at a price, right? It could be a very interesting sub-segment or environment, but if the valuation goes out of the direction you would like to pay for on a risk-adjusted basis, whether it's become a right view or not, it requires second evaluation. I think that's very true. So with that said, maybe I move to the third question. It's more on my end related to regarding the current various headwinds we're facing, right? I would say everyone probably will agree today is a completely different from maybe a year and a half or 2 years ago, what we are facing. There's an ongoing global geopolitical environment, which has resulted various uncertainties and the risks, as well as the pandemic, which completely changed our daily life. We probably spend more time working from home these days than ever. And so I guess my question is more regarding with that concept, during your investment strategy, on a risk-adjusted basis, is there any preference between high growth company or you're more focusing on strong cash yielding business? So it's a balance, the trade-off between growth versus current income. So with that, maybe I start to go to one end of the spectrum to Crystal, because you guys obviously focus on the high growth business. Any comments?
Yeah, yes. I mean, for us, the headwinds are challenging, but as an investor, you always have to be optimistic, right, to capture opportunities. So we look at it with a more upbeat tone. For example, the valuation difficulties that Jie talked about. We navigate that it through being more selective and passing on even very promising companies if the valuation is wrong, and in a few cases we've benefited from that action. For example, very hot pre-IPO round or IPO cornerstone opportunities turned south after IPO with the current softness in tech stocks, and that is continuing into the year, we think. And we think the public market moderation will translate into private rounds sooner or later. So we're on the look for valuation adjustment to somewhat. But of course, there's no cheap deals if it's a truly transformative business and great management team, right? So, another challenge we think is related to market structure. Especially in the venture capital scene, with the top players being so dominant and so full of capital. I mean, they raise tens of $billions of capital as a technology investor, with investing into a round. It doesn't make sense. And yesterday there was a viral social media article. The title is "Living in the Shadow of Sequoia and Hill House." I mean, it speaks to the pain of smaller participants here in the venture capital industry. But we're seeing some signs of change. For the last several years, there's very few spin-offs. But with a very strong IPO market and with the younger partners finally being able to clip some carry, we're seeing some very good talent spinning off from the top VC firms. So that is encouraging, and we're continuing to follow these talent. And two, we're seeing some entrepreneur turned investors in the scene. Especially targeting their industries where they made success, and I think that's a very good recipe for success. So that is two. And three, targeting differentiated industries. For example, we backed some deep tech or hard tech focused early stage VCs here in China, and for the longest time, hard tech, things like IC design, is not an opportunity set here. It didn't make sense. But now with ASIC, not general chip, but ASIC, with China, at an equal cutting edge of AI technology, autonomous driving, EV, these opportunities, we think the opportunity set for deep tech, hard tech is there, and we're seeing the top VCs being not as capable or late or focused in such big opportunity set, which creates room for new disruptive new entrants, emerging niche focused VCs. So that is also what we're watching out for. And thirdly, given we have a global mandate, we're also seeing good internet opportunities in emerging markets. For example, in Southeast Asia, social e-commerce is emerging and it's gaining very good traction. Even in markets like Africa, internet and all the success stories in the US and China will be repeated to some extent in Africa, and we're seeing good opportunities there as well.
Thank you, Crystal, for sharing all these insights. Seems you guys are focusing on the most sexy industry in the markets right now, at the forefront of most of the traditional investors are looking at. So with that said, maybe I also would like to ask Wanlin, because as a late stage growth capital as well as the buyout players, what's your focus area right now in the current environment?
Right, that's a very good question. I think we try to get the best of both worlds in two senses. One is that by looking at both buyout and growth deals within the same industry, it gives us a good perspective and very complete perspective as to how sustainable are the incumbents, and how much I would say momentum does the new entrants really have, and whether they have a good shot at penetrating the existing industry. And secondly, we also try to bring growth to the cash flow yielding companies. So for example, we have invested in traditional and long-standing brands such as Luolai, which is a leading home furnishing brand in China. And we have also invested in McDonald's, which is a very traditional fast food brand chain. And we try to inject technologies and new tools. For example, Lola implemented mini programs on mini programs on WeChat for their distributors, and enable their distributors to better maintain customer relationships. And McDonald's have launched their own app, and very quickly grown their user base, as well as increased delivery sales, especially amidst the pandemic. So I think we try to get the best of both worlds by bringing high growth to traditional cash yielding companies.
Thank you very much, Wanlin. I already notified we only have 8 to 9 minutes left. I have one more question, and afterwards I would like to open to the audience to see if anyone has other questions for the panelists. So on my end, I appreciate the comments that Wanlin just shared with us in terms of try to balance and adopt the best of the both universe whenever you can. So the question I have is more for potentially Joseph, right? In the traditional segments, what excites you the most? What kind of stuff you are looking? Because you touched base on it during the initial opening about the adoption of the new technology, potential new business model. We'd love to hear a little bit more insights that you can share with the audience.
Thank you. I'll keep it fairly sort of short and sweet. I mean, I think the digitalization, I think Jay made this point earlier, but I think it's incredibly important. The digitalization of a number of industries is making a massive difference. So at a very sort of basic level, a lot of farmers have smartphones now, and that creates huge opportunities. And we invest in the agri sector, and the ability to deliver information and use diagnostic tools on a smartphone in a farmer's hand can potentially make a massive difference, both in terms of improving, educating those farmers, improving the yields that they can make, and improving their use of seeds and the whole range of sort of agri inputs. That has huge potential implications for food security in countries across Asia, which is obviously an issue that's very important to ADB. So I think that at a very sort of basic level, the rapid spread of handheld smartphones is going to make a massive difference, and we're only really in the very early stages of understanding how we can use that technology and that exposure across so many different countries and to so many millions of people, what opportunities that will create. So I think there will be huge opportunities in very traditional sectors such as farming going forward because of that new technology. And I'll be quiet now. Thank you.
Thank you very much, Joseph. This is very interesting. So look at the questions which has been asked. Maybe I take the first one. Actually, it's a very big topic. people ask what's the impact of COVID on these high growth company and investment opportunities. Any panelists would like to chime in on this one?
Well, often COVID is credited as an accelerator while being a public health crisis. The technology companies that have done very well before COVID just saw themselves getting another boost from the epidemic as the world moving online. So I think healthcare equally got a lot more spotlight because of the nature of COVID. Healthcare services, remote medicine, etc., all have accelerated the trend line. So in a bizarre way, this pandemic has hit different sectors very differently. For some, the winners and losers are very, in a way, occupy very dispersed and bookends of the spectrum. So this is one very peculiar thing about the crisis we just witnessed.
Thank you very much. And then there's another follow-on questions is regarding while we're talking about the high growth companies, opportunity people are excited about, but it's always good to have a real examples. I heard something from Joseph about the farming, the new technology adoption. So I'd love to hear maybe one concrete example from each one of you guys. Try to keep within, let's say, 1 minute. Something you are most excited about in your current portfolio for the next few years. So shall I start with Crystal?
Yeah, sure. The thing that comes to mind is a SaaS company in China. It is similar to Adobe in many senses. The first thing it does is an analytics cloud. So allowing companies to analyze their web view, where their users are spending time, where on the web page the users are staying, what they clicked, and what that result and what that resulted in. And the additional local feature is that it does a very good job analyzing WeChat user behavior. So that's the analytics cloud, and that business is 60% gross margin and growing at 50% annually. And the second growth curve, second S curve, is the marketing cloud built on the analytics cloud, and it's growing. It's doubling by revenue per year for this company. So the company is valued at less than $2 billion today, growing fast, and Adobe in the US is valued at over $200 billion. So a lot of growth to expect.
Thank you very much. I see why you're excited. So it's potentially to be 10 or 100 baggers, right? Okay, maybe Wanlin, we have another 2 minutes left, 30 seconds for you. One most exciting idea you have.
Sure. So we have invested in online education company. It's not one of the biggest ones, but it's a leader in its niche, and I'm excited about it because it actually has created a proprietary content and really created its own category, which was not available offline. So it teaches small children between 3 to 8 years old logical thinking, and that used to be very hard to do in an offline setting. It's difficult to get the concepts through to the students. It's difficult to get the kids' attention span, and they created interactive content based on all the digital tools you have, so the kids stay very engaged. They can learn and play at the same time, and it's very effective. So I do think this really fundamentally changes how young children learn about math and problem solving, and I think it's not only helpful for them getting better scores at school, but it's really helping them to build out their intellectual power.
Thank you very much. So maybe I go for Jay, given the broad scope. Anything excites you in your portfolio right now?
Well, I'll talk about the broad scope. I feel biotech hasn't got any airtime today, so why don't we just spend 30 seconds on that? Chinese biotech actually has some distinct advantages. Number one, the research development as well as clinical trial cost in China is much, much lower than that in the US, which enables the acceleration of drug discovery at a fraction of the cost of that of the US. Second, large population, great demographics that doesn't need any belaboring. Three, we all know Hong Kong now has accepted IPO companies IPOing on a pre-revenue basis. So multiple exit routes, also big appetite by farmers to acquire a portfolio.
Thank you very much, Jay. And last but not the least, Joseph, other than that farming to adopt new technology, anything else you would like to share?
So the tourism sector, it's probably a bit surprising, but a number of Asian countries are very heavily affected by COVID because they're very dependent on the tourism sector. So this very much sort of plays into our sort of development agenda, but also, tourism will return. People will go on holiday. And while it's terrible now, in 5 years' time, hopefully we can put it behind us and we can all enjoy a good holiday. Thank you.
Fantastic. I think I learned so much from you guys through the last 45 minutes. I want to thank the panelists for your contribution. So this concludes this panel. I will pass back to Xiaoling.